In this video, let's review the calculation of depreciation that we had learned in Chapter 6 called the Modified Accelerated Cost Recovery System, or MACRS. What you're looking at is problem 57 at the end of Chapter 6, where Casper is going to have to calculate depreciation for the year 2015. And what we're given is a list of depreciable assets. And notice that the dates they were purchased is not all 2015, but prior years. We also are told that none of these assets were deducted using Section 179. And we had learned in Chapter 6, 179 would accelerate the deduction of the cost to the year purchase versus spreading out the deduction over the useful life. We're given the cost of each asset and its classification, the class lives. Usually computers and peripherals and autos are a 5-year class life. General equipment and furniture is 7 years. And real estate, in this case non-residential, is I believe 39 years. And we need to use the depreciation rates at the end of our chapter 6. So here we're given tables to get those rates. So let's do the first one here. A computer purchased in 2012. Now, again, we're not calculating the 2012 depreciation, but the 2015. So using this table 6A, the computer would be a 5-year class life. And in 2012, the year the computer was purchased, we would deduct 20% as depreciation. So this is 2012, 2013, 2014. For 2015, we get an 11.52% depreciation rate. So if we multiply that cost, this 3,000, by 0.1152, what we get is 345 and 60 cents. And here in our red instructions, we're told to round to the nearest dollar. So 350, 346 would be our answer here for the first asset. Let's try the second one here. Again, another computer bought back in 2012. But we're told that during the current year of 2015, it was sold. Generally, our so-called convention. Convention is the calculation of the depreciation in the year you purchased and the year disposed, sold the asset, would be the so-called half-year convention. Here, half-year convention. So built into this 20% for the computer in the first year you purchase would be really a half year's worth of depreciation. And then the rest of the years would be full years. Including this 11.52 would be a full year's worth of depreciation. So when calculating the depreciation for this second computer, we would still multiply it by that full year of 11.52, but now we take half of it, let's say 0.5. So when you multiply all of this out, that comes out to $144 of depreciation. 144. Let's try this furniture number 2 that was bought a couple years ago at a cost of 3,600. Again, general equipment and furniture has a 7-year class life. And you can see those class lives for specific assets mentioned in our chapter 6. Make sure you read the chapter and watch the video lectures. So here is our 7-year. So the first year would be the year we purchased. Now it's 2013, 14, 15. So 17.49% is the depreciation we would take here. 0.1749. So when you multiply it out, I think you get a number you have to round. 629.94. And we all know 50 cents and up we round to the next dollar. And below 50% we just chop off the cents. So 630 is our depreciation for this furniture number 2. Let's try the office building purchased this year. And you have to make sure that you know the difference between residential and non-residential. This is a non-residential, and we're using this table 6A-8, and we use the so-called mid-month convention for real estate. In other words, you got to identify the month we bought the asset here. So April, that's the 4th month, and now we're going to be using this column for the rest of that building's life. In the first year you purchase that building, you get to deduct 1.819% of the depreciable costs. And then for the next, looks like 38 years, this is your rate. And in the last year, this is your rate. Of course, this is our first year, so this 1.89 is the rate we're going to be using. So we multiply the depreciable costs, keeping in mind you don't depreciate any costs allocated to the land. And we should come out with, again, you got to round to the nearest dollar. I believe it's $6,003. So let's just submit and see what happens here. So it looks like I got the ones I attempted correct. So you guys gotta try to figure out the rest over here. Again, this is problem 57 at the end of chapter 6.